Hello, I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights to help boost your trading potential. Coming up, Jessica Inskip from stockbrokers.com joins us with her early year playbook as markets weigh jobs data, Fed policy, and of course, upcoming earnings. She'll also explain why AI's next phase may hinge on energy infrastructure and not just innovation. Plus, defense stocks are in focus following a vow to bump up U.S. military spending. We're taking a closer look in today's technical take. That's all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. Half an hour to the trading day. Let's check in on the S&P 500. Market's sort of looking for a direction after touching new highs this week. Of course, we have jobs data tomorrow and a lot of important big events coming up, and we're still really early into 2026. So we got a bit of weakness out of the gate. The Dow has turned modestly positive. The S&P 500, that broad read of the market, still a little bit underwater. Let's jump into the heat map. I'll start telling the story of what's happening with that top line number. You can see that some of the big tech names really aren't helping us today, whether it's an Nvidia down more than 2% and Apple almost by that amount, but it is a mixed picture. Google's just sort of flat. So yeah, we'll see how the day plays out. The healthcare stocks, I noticed earlier in the week, they were moving together as a group to the upside. It's a bit mixed today, so we'll continue to look for green on the screen throughout the day. Perhaps this is still in the green. Lockheed Martin, U.S. defense stocks getting a bid. As President Trump calling for a defense budget of $1.5 trillion next year, he made that call on social media. Of course, it's interesting times when policy is announced on social media, but the market does move off of it. Lockheed, a lot of its other defense brethren have been getting a boost off of this. Alcoa, I want to check in on the aluminum producer, a victim of its own share price success. Perhaps Wall Street has valuation concerns. Of course, the stock surged more than 70% over the last year. It is analyst at JP Morgan in particular also pointed to tariff uncertainty for the aluminum producer, so a bit of a pullback for the name today, but we said it's been on a pretty strong run. And that's your market update. Joining me now from London, Ontario is my colleague Hiran Amin from our direct investing educational team. And from Jacksonville, Florida, we're joined by Jessica Inskip, Director of Investor Research with stockbrokers.com and host of the Market Maker podcast. Before we dive into the conversation, just a reminder to our viewers that the views and forecasts expressed are solely those of Jessica and her team at stockbrokers.com based on their research. Jessica, great to have you on the program. We've seen markets hit new highs to start the year. We're still very early into the year. Today, we're sort of looking for direction ahead of a key jobs report. What's your feeling about these markets? Are they confident or are they a bit cautious?
I think that they're cautiously optimistic, which is a word I feel is overly used in finance media. But nonetheless, the reason for the caution, of course, is we're waiting on what's happening with the labor market. But the optimism is this is no longer a narrow tech-only market. Leadership is broadening, earnings are improving, and the AI story, it's evolving. It's not ending this. I don't see the bubble mentality. The S&P 500, like you said, it's making all-time highs, but the S&P 500, if we look at the 493 securities relative to the Magnificent Seven, the Mag 7 is actually underperforming from a relative basis. But if we combine that with all-time highs, that tells me broadening and strength beyond the AI narrative, which is very positive in my view.
A lot of people have been waiting for that broadening, so that would be positive. And I think in a lot of people's views, Jessica, you've said the labor market right now is the bigger risk for the Fed when it tries to weigh its policy going forward. Of course, we got a jobs report coming tomorrow. What number here could really move the markets?
Well, it's certainly the unemployment number. There was a speech that Fed Powell gave us earlier last year when we were talking about the shifts of the balance of risk from inflation versus the labor market. And when he saw the labor market balanced, he quoted the low fours. Well, 4.6% unemployment is no longer the low fours. So it's really the big risk is a higher number that we see tomorrow. Obviously, anything too high, we too far, too fast, and any place in the market is what's going to cause volatility, and that's the type of shock that I'm concerned with. But if that gives us more cuts on the table, that's going to be very, very, very helpful. But it's very interesting, and balanced labor market that I see so far with some cracks that are there. We haven't had some numbers today. Productivity surged to 4.9%. That's very, very high. Labor costs have declined. That combination together is very market friendly. There's more output, less inflation pressure. That on the other end, though, the no hiring and no firing, I feel like that's easing. The trend of the companies just freezing headcounts, that's moving down a little bit. So something to watch there. So basically, we've got less jobs, but people are doing more with less. And that is good structurally for the market, but it could also elevate the K-shaped economy.
Okay, so Jessica, let's talk about the more with less story then. So markets are widely expecting 1 to 2 cuts for 2026. I think the Fed, based on their notes, probably 1 cut's baked in. So do you think, based on what this number might come out, the Fed is done, or is there still room for another cut this year that might play out?
There could be room for another cut. Remember when they give us the dot plots in the SEP, Powell always says, this is not a plan. It is certainly where we forecast and we see things in the future, but it always changes based on incoming data. So like the Fed, because they're the ones ultimately making that decision, I want to see the reaction of the markets overall. But I do think there could be more rate cuts on the table depending on what happens tomorrow. Are the risks elevated for the unemployment picture? I personally think they are elevated, and if tomorrow's report gives us any other indication of that, that will put more rate cuts on the table.
Yeah, let's actually talk about something you just mentioned a moment ago, is this K-shaped economy. So is it still a K-shaped economy, and how long can higher income consumers still carry growth?
Well, I think they can carry it for certainly quite some time. We've seen that play out within the market, but I think that is a larger concern. And that actually is something we can pinpoint into the data. If we see job openings or the job expansion is more on those lower income type of jobs, that tells me there is more pressure within the economy overall, and that is something that I think we cannot handle. So I think it's a very delicate balance, but it's the high income consumer has held us up thus far. We also have to remember there's a couple of other data points that is very, very difficult to measure. So one is the AI and increased productivity and how that's falling through. We can look at productivity, we can look at revenue per employee if we want to dive into individual securities, but post-2008 and post-Great Financial Crisis, this is when really the gig economy was born, and we saw emerging the likes of Uber and things of that nature. So what I'd like to consider is, prior to 2008, or really now, there was no option if you lost your job to go have that gig economy, go sell an ebook online. People do that, or to go drive for Uber. There's so much that's connecting us that allows you to supplement your income, but sometimes that type of double jobs, that is secondary income or contract work, it's very difficult to actually pinpoint that and see the trends in that. And I think that's also helping the lower income cohort.
So let's actually talk about the health of the consumer then. So earnings season is about to kick off into high gear, starting with the financials next week. A lot of the banks are going to be coming out. Is there anything that you'll be kind of parsing through with the bank results that will give you an indication of what the health of the U.S. consumer is?
Absolutely. So they will give us an insight into their balance sheets. There was something that Brian Moynihan said, the CEO of Bank of America, last quarter, relatively recently, within the last 6 months, where banks are cushioned for a very high 6% unemployment, which tells me, again, going back to this shift from post-2008, where we have a resilient consumer, but we also have resilient companies and a resilient banking system because we've learned from past mistakes. So understanding that positioning and where they see spending overall, but also balance sheets and stress within the credit market is all going to be great insights from those banks, and very specifically Jamie Dimon and other bank CEOs giving us indications into those cockroaches that were called, maybe hinting at bigger ones. That's going to be very important. And regional banks really matter here because stress tends to show up there first. So definitely credit stress and also what's happening with the consumer are very important.
Jessica, off the top, you're talking about the market broadening out from just that AI push and the hardware push of last year into more productivity. If we stick with the banks, in Canada, we've talked about the banks being a way perhaps to play AI productivity. Will you be looking for that too in terms of the themes of this year of a productivity story of sort of the expansion of the AI trade?
Absolutely. I do find it very interesting, some conversations that I've been having. So I talked to a lot of the retail brokerage firms here in the US. And what's interesting now from just a productivity gain internally is they're utilizing now AI systems. And it's, if you utilize AI and a heavy AI user, you can certainly do more with less. But productivity is very difficult, like I said, to measure. So I think that happening more broadly, but very specifically with the banks, there is this expansion of that, the AI trade, if you will, that to efficiency and tokenization, digitization, stable coins. And we can see that with this fiscal environment that is very conducive to these trends that we're seeing. But also there's a regulation from the CFTC, there is more commentary from the SEC. And so now that we see more tokenization of assets and even going on to real world assets because of what was announced with Coinbase even earlier, I think that is more of a broadening that we can play on the banks that's not necessarily related to artificial intelligence, but productivity and efficiency gains. Because ultimately, tokenized assets is going to lead to faster clearing, which is going to lead to more retail trading, more broader access. So I think that is a huge theme. So any banks that have exposure to that, which are quite a few of them. Of course, the risk is broader adoption, but nonetheless, I think that's an emerging theme where there is a lot of fiscal support around, and it's helping us globally as well.
Let's jump deeper into the crypto stuff. I think when you and I were discussing yesterday, there was a while, Jessica, where you didn't really talk about crypto. You're saying obviously now there's more interest in the space, new regulations and ETFs. So I think the question's still out there, Mark, speculative trade or something more structural?
Yeah, so I think it's a combination of both. I still see crypto as a speculative asset and it's a risk asset, but I also see technology as a risk asset. We're going to look at risk on versus risk off. Those are the measures that I'm going to see purely from just analyzing the broader market. However, from an analysis perspective, I'm looking for the bid. Where is there more demand for this underlying security? And I do think that's coming because of global market expansion like we were discussing. And the reason why I've started bringing it up again was honestly administration change. Once we had this new SEC chair, and I see the Clarity Act, and I see the Genius Act, and I see all of this fiscal policy that is pushing forward for digitization, that goes along with cryptocurrencies. Now we see an introduction of the ETFs coming into the space. There was a recent announcement, I believe it's yesterday or today, but with Morgan Stanley even venturing into offering some more ETFs. So that is going to create more of a bid. It creates more of confidence within the consumer and the retail space, which then it's a domino effect from there. But what we were talking about, what I think is just an interesting perspective, is when you have this expansion of 24/7 trading, you've got brokerage firms that have very large global access that will allow you to have accounts no matter where you live. But now this access of 24/7 trading is for our friends over in APAC, where they want to access US markets, but do it on their time and not use the likes of CFDs or other alternative models. And the way that they can do that is with 24/7 trading. Even tokenization is a piece of that. But to fund those accounts, it's so much easier to do that via cryptocurrency than it is with opening a US bank account. And so the broadening out of the retail trend shift globally is actually a bull case for Bitcoin or other cryptocurrencies, in my opinion.
Okay. Jessica, we're going to just pivot a little bit and go back to the energy story, because obviously we've known that the energy is making headlines this week due to the political upheavals that's been taking place. But you're framing energy more as an AI infrastructure story, maybe an AI adjacent story, and for good reason. They are power hungry. So where do investors sometimes get this wrong? And you can talk to me about that a little bit.
Yeah, absolutely. So we look at certain subsectors of energy. I like to separate them out from the oil aspect because they tend to be tied to oil prices. And if we have a fiscal environment where we are looking to bring down oil prices, I don't think that's necessarily bullish. We'll start seeing less oil rigs. We won't see any reasoning to expand that, if you will. But from the data center perspective, I think this is an opportunity, but it's also the risk. So it's an opportunity as a piece of the AI narrative, and we can see this with accelerated earnings growth expected in industrials and materials, utilities, in addition to energy. Those are beyond the Magnificent Seven for just the growth that's expected. So it speaks to the broadening, but also specifically your question. There is so much pressure within the grid, and we are building AI faster than I can even keep up with. I mean, we've even discovered new ways for consumers to utilize that. So more broader adoption, though, means more pressure on the grid. Within the US, we've got very outdated infrastructure, which is why I believe we see that increase in earnings expectations for industrials and materials and utilities. And then, of course, that leads on to energy and the grid pressure. So it's going to be very important to update that, which means there's going to be spending there. We're going from chips and cloud to data center, power, construction, and infrastructure, and that build-out phase could be the next growth driver. Now, the big risk that we have with that AI narrative is big CapEx spend, which is leading into our GDP, which is also these large data centers. So if we cannot keep up with that, we put things on the backlog. That could be the larger risk, that, in my opinion, for the AI narrative. And of course, it will take some time to play out. And what we have learned are companies are resilient, prepared, even adapt quickly. We saw that with COVID, I think, is the best example of companies adapting very, very, very quickly. But it is a risk and something to watch.
Jessica, when I think of a lot of the bullish cases you've laid out for the reason for the market, and overall Wall Street is bullish on the market this year. The average, I think, target for the S&P 500 is about 7,700, give or take, depending on the analyst. We take a look at the bond market. We take a look at the run that gold has had as well. What are bonds, what are precious metals telling you about the risk sort of out there right now? I feel like the equity markets are sort of ignoring all the big risky headlines.
The equity markets certainly are. The equity markets, I feel like, are getting more used to this uncertainty and expected volatility, but we can also see there's a shift of focus more towards the bond market, if you will. And it makes sense. I've referenced, and I didn't even expect to do this with this discussion today, but I've referenced really the change we've had since 2008, and that is an interest rate environment, but also just what we've learned and having rates at levels we haven't seen since 2007, which puts that focus back onto the bond market. And I really think that the one thing that has changed from 2025 to 2026 is the Fed's proactive stance in the bond market. We've moved into this ample reserves regime in response to what's happening with repo markets and the money markets scare that happened in 2019 and then again later on. But what we saw is the Fed taking this proactive stance of really calming funding stress and supporting risk. So the conditions look a little more constructive because I see the Fed coming in, and that I think is a very good thing, but that has to do with the ample reserves regime and what that looks like. And that's relatively new. The standing repo facility is something as of 2021. And then, of course, with our last Fed discussion, he talked about more of buying, but I don't see that as QE in the sense as we are used to it because of these newer programs that have been implemented in 2021. And then, of course, you did ask about commodities very specifically. I do think it's interesting what's happening with the US dollar, and maybe we're having a currency shift of some sort, but nonetheless, that looks like what's being correlated with gold as I look at dollar weakness, dollar strength, and what's happening with gold, and there is an interesting correlation there. So something to pay attention to. And then from the sectors specifically, it points back to commodities, to artificial intelligence. Copper is something that's needed for artificial intelligence, so a rise on that purely because of the demand to create something that every company wants in a board shareholder meeting creates a bullish case, in my view.
Just going to wrap up over here and get you to give us a look into 2026. So if you had to name the single biggest risk to the market in 2026, I'm sure there's a lot to pick from, but I'm going to ask you to just choose one. What is it, and what do you think investors should be most closely watching for this year?
Oh, it's a very, very tough question, but I'm going to say the biggest risk is the grid pressure, because the market right now, even though it's broadening, there is this AI narrative, and there is a wall of worry with the AI narrative. If that wall of worry becomes a reason to worry, then that could certainly have earnings pressure. And if we're looking at the markets, they move on earnings potential. If we have grid pressure where we cannot keep up with that demand, that can hurt the consumer with higher utility cost. That will debunk or pivot, if you will, the AI trade. So that to me is the biggest risk, and it would be a shock. We're always looking for shocks. That is a shock that I'm watching for.
Jessica, great conversation. Really appreciate you joining us today.
Yeah, my pleasure. Thank you for having me.
That was Jessica Inskip, Director of Investor Research with Stockbrokers.com and host of the Market Maker podcast. Just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Here, and Jessica said a number of very interesting things there. I don't even know where to begin. Maybe I'll talk about her talking about the risk elevated in the jobs market. We do have a jobs report coming out of the States tomorrow. And then it bleeds into me that idea of the AI efficiency, companies doing more with less. We often think of less humans, but where does those stresses start to meet in the U.S. economy if fewer people are working, but companies are more efficient?
Yeah, absolutely, Greg. I mean, there's a lot at play here. The jobs numbers are obviously going to be very closely looked at. We've got two meetings with Fed Chair Powell still in running the show there until May and until his replacement is called. But if the number ticks up a little bit higher, then we have a cut. But it also, remember, the administration is looking to reshape the balance of that Fed committee itself and what that could mean for future cuts of what they're trying to target there. But Greg, the risk, I was a little bit surprised with Jessica when she said, what's the biggest risk? And she mentioned the grid capacity. My mind never went to it, but if you think about the downstream effects to get these data centers, get them up and running, to get these AI, productivity applications, you need those big data centers and you need someone to switch on those lights and keep them running. And traditional sources are going to be what's going to be relied on, and we're not. I come from a place where we had austerity measures with energy. They'll turn off the lights a few hours in the day, and then you'd have to just have shared energy. So hopefully we don't get to those days, but that's interesting to keep a close eye on and a space on, and see what the development is in sort of adjacent technologies that could power these data centers and AI infrastructure.
All I can say is if I don't get a hot shower in the morning because someone else is using their app to create some crazy picture or video, I will not be pleased with the way things have turned out.
You and me both, Greg. You and me both. Cold showers is not what the calling is for and where we live. So absolutely not.
That is no way to live. If you at home have a question for our guest or team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try the platform risk-free. Just open a practice account by clicking on that Try TD Active Trader button. Then when you're ready to switch to a live account, simply export your workspace and start trading for real. Right now, for a more technical take on what's happening in the markets here, and you're tracking a defense ETF. Big headlines here.
Yeah, big headlines, Greg, of course, this week. The one we're looking at today is ITA. It's the iShares Aerospace and Defense ETF. It gives exposure to about roughly 41 U.S. companies that manufacture commercial and military aircraft and other defense equipment. Top four holdings would be like GE Aerospace, Raytheon, Boeing, and Howmet Aerospace. But the reason we want to look at this is for big headlines, of course. We know that there was recently military action. The defense space as a whole, like out in Europe last year because of the geopolitical tensions, they were quite on a rise. And domestically over here in North America now, with some of these American companies, they've started going on a bullish run over here. Now, there's a couple of things that I think that are catalysts to this. One is, President Trump has revived what's known as the Monroe Doctrine of the 1820s. And that's essentially emphasizing the need for the U.S.'s dominance in the Western Hemisphere. And, this week, of course, he's referenced names like Cuba. We know what happened with Venezuela. And most recently, of course, Greenland. Now, when you look at the overall defense infrastructure, like today's tweet, of course, came out where he said, we want to move that dial up from $1 trillion to $1.5 trillion of spend in defense, and that's obviously caught up a big bid. But overall, by 2030, the projection is to surpass $3.6 trillion in global defense spending. That's going to be up 33% from the 2024 levels. And the final thing is when I was creating my charts, which we'll go into a moment, I always think, okay, I'm in front of the headlines until I'm not. And yesterday, there's a tweet that came out that said, the administration of President Trump is threatening to ban stock, buybacks and dividends, and essentially cut off shareholder returns for major U.S. defense contractors unless they can speed up weapons production and reduce cost overruns for these firms that are running over budget and are falling behind schedule on some of these weapons programs. And they have the drafting, at least from what I gather from the Reuters report, is that they're targeting firms like Lockheed, Northrop Grumman, Raytheon, Boeing, and General Dynamics are the kind of ones in the crosshairs there. So that's one to keep an eye out. We'll see what plays out of that. But let's look at the charts for a second, Greg. I've got this ITA chart, and you can see I've mapped it out until, starting as of May last year. We've gone in this strong bullish trend. It's respect to the trend. We've tagged the top end of it. We've tagged the lower end of it. We did have a breakdown in November when we had a little bit of a market pullback come down. We did go on this lower trend, but we've now, what this has essentially created is we've regained at this point, just most recently coming into the close of last year, it regained that and made this telltale pattern that I like, which is the bullish cup and handle pattern. We saw the handle formation. This is a bullish pattern for a next leg up. I've got this little arrow, Greg, that I marked up here, what is considered to be a measured move when you have this sort of pattern play out. You take the base of the cup to the top of it, and that would give us an expectation of where we could still see the price still going to. It's targeting about that 245 area there. I did map the 230 level yesterday as a resistance because it is hitting new all-time highs. We just had an all-time high, and today, I think we just tagged the 240 level, which is going to be a new all-time high. So this is all about price discovery at this point. We don't have an upper ceiling on the price, but we are going to see where the price closes today to see whether this 230 is a valid test. And if it does settle at 230, we'll know that this has now become a new support area potentially going into this next few weeks here.
All right, so that's the ETF. You're going to pluck a certain name right out of the ETF that's part of that basket, Boeing, and do a deep dive on them. Walk us through your thinking here.
Yeah, why not? Let's pick on Boeing. They've, I looked at them for a reason other than defense, but they really do have big defense exposure. Boeing's been, come off a little bit of doldrums. The last couple of years, they've had stagnant sales. But yesterday or a couple of days ago, I would say, they just received their largest ever order from Alaska Airlines, purchase order for 105 737 MAX 10 aircrafts and 5 of the 787 Dreamliners. Now, this is going to boost the total orders to 245 with options of 35 more. Now, you'll recall, Greg, in 2024, this was the airline where a door plug panel blew mid-air. So it really is telling about the confidence that they do have and airlines or carriers are giving into Boeing. 737, remember, is the primary revenue driver for Boeing. It's very closely monitored whenever we have the earnings report, which is actually coming later this month, on the delivery rates and order fulfillments that they have. But I also wanted to note that the 73 MAX hasn't even received FAA certification yet, from what I last reported. So it's still interesting to see that certification clearance. We did have the government shutdown, so hopefully that'll be just around the corner. But what I also wanted to mark was Boeing has 6,600 unfulfilled orders on the commercial side. That marks over a little over $500 billion in value in backlog. They did about 600 jets delivery in 2025, 700 is expected for this year, and 800 in 2027. So they've got a long runway. And they're also turning a bit of a corner because after coming off of a $2 billion free cash flow loss, they are looking to get into positive territory this year with low single-digit free cash flow there. So we'll look at that. We'll keep an eye on the defense. But here's how the story's being played out. I've got the weekly chart pulled up, Greg. So each candle represents a week's worth of price action. Wanted to really zoom out. And one thing I wanted to just paint was I just wanted to gain a sense of a pattern that Boeing's been trading in the last couple of years. You can see that this cyclical pattern where we have these sort of run-ups and then run-downs. One thing that I wanted to mark is I marked the upper end and lower end of the highs and lows during this period. You can see it's very much respecting the upper sort of downtrend that we have and then the lower uptrend that we have, tagging it each time and bouncing off of it. And one thing is we are seeing pricing increase just more recently into 2024, and last year we have seen a short-term, let's call it interterm for the weekly channel, going on a steady rise. So we are forming an uptrend within this triangle over here. Now, I'm going to zoom in a little bit more over here, but what we also have that I've marked is on the weekly price action, this is the first time that we've had consecutive 7 green weeks. Now, Friday is going to be important. Tomorrow's close is going to be important. If it closes in the green, this is going to match what they did back in 2023 with the 7 consecutive bull greens hitting the top and then reversing off there. So there's a bit of room to run. I'm monitoring this top end. We've seen rejection happen at the top end over here. So it'll be interesting to see if we can clear that on a weekly basis. So we want to see a couple of weeks price action and then retest it to see if we've finally broken out and we might be on into another bullish run. But remember, there's a catalyst event January 28th. That's when the earnings are going to be released there.
Now, of course, on Thursdays here, it has to give us both the possible bull and bear ways to play this. Before we get going on Boeing, just want to remind our viewers that the options trading carries high risk, may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Where do you want to start, bull or bear? Your choice.
Let's do the bull, Greg. We'll start with that with a good news story. There's a little bit of tailwinds that have obviously played down for the sector as a whole. So we're going to look at a potential bullish strategy over here, and I'm going to just switch back to my daily chart that we have here. So what we have is a strategy, given that Boeing has earnings coming out later this month, and it's been volatile, so the stocks, the price of the options tend to be a little expensive. And if we wanted to still play the upside to this, one potential trade you could do as a bull is a long call butterfly trade. Now, what this trade is it is made up of sort of 3 parts to it. So one is we're looking to buy a call. When I mapped it out yesterday, I was looking to just go out of the money. Yesterday, the closing price was about 228. So we look to get to 230 even price over here. And then we're looking to further sell where we believe the stock could reverse after a long run up. And that's the 250 level, which marks a significant resistance level over here. Now, what makes this a butterfly trade is we're selling 2 contracts on the short side of it, on the 250, and then just to even it out, so we're not exposed to that one sort of uneven short sell, we're going to buy a further even distance, so it's 20 points out, 270 call to sort of lock in our risk end to end over here. Now, what I wanted to take everyone through, this trade at the time I set this up was going to cost us roughly about $5. It's a debit trade, so we're going to be paying for this trade. So I've marked the break-even zone. That means we need Boeing to at least push up to the 235 level on this trade before we start hitting a profit on this trade. Now, you can see, Greg, I've already marked the max profit and max loss. So I'll just talk us through how we get to that. We get to it because we want the price to rise, and we needed to get to the 250 level. And we kind of wanted to stop at that point, okay? So if it stops, then we will realize max profit, and that's simply taking the spread of the width. So the spread in this case, sorry, the $20 minus what we paid, $5. That means we make $15 or $1,500 if you were to do a single contract on this. Now, we like talking about risk, right, Greg? What's the downside to this?
Always got to know the downside.
Yeah, we always got to know that. The downside is, well, the downside. If the stock doesn't, in fact, go up, we end up losing on this trade. So if it stays below 230 or less, we will start losing on this trade, especially if we hold it right till the expiry there. The other side of this trade as well is not so much a downside, but is if the stock also keeps moving to the upside. Now, that's kind of a little bit of a juxtaposed to what we want it to happen. We do want it to go up, but remember, we don't want it to go beyond the 250. But if it does start crossing beyond the 250, it starts eating into our profits. And if it does get all the way up to the 270, then it's a scratch trade pretty much. So we made 20 on one side, we've lost 20 on the other. So we're going to be out, but we'll be out only pretty much what we put into the trade, which is like the $4 there. So that's just one thing that this kind of starts working. It's like a double negative. It starts working against you if it starts going into the 250, above 250, and then hits the 270 level there.
All right, that's the long call butterfly. If you took a possible bullish position, what about a bearish position?
So today we're doing a twin trade, Greg. I'm just doing the exact same trade on the downside. So we're doing a butterfly. So let me pull up the bear trade, and we're doing it with puts in this case. So same idea over here. Again, we want to do this. Remember, this trade is done, so we want to minimize as much of the cost as we can, so it improves our overall break-even price, which would improve where we stand to start making a profit on this trade. So again, we've got a bearish option trade, long put butterfly. We're just doing the flip side of this. We're looking to speculate to the downside, expecting a downside move. So we're going pretty much close to the money. So we're looking to buy the 225 strike put in this case. We're going to the March cycle. Now, the March cycle, in fact, was cheaper than even a shorter cycle. So this is why I looked at it when I was looking at putting the trade. And then we've got, we're going to sell an equidistance. So again, my spread is going to be $20. So we're going to be selling the 205s, two of those, and then buying further 185, which will keep us at an even distance. Now, this is what makes the shape of the butterfly. When you look at it, when you actually put on a risk and, profit and loss graph, it looks like a butterfly-shaped wing. You got the double shorts and you've got the longs on either side of it, which is what the wings are essentially. Now, this trade was costing us $3.75. In other words, on a single contract, it would equal to $375, not including commissions, of course, as part of this conversation. And we want the trade to go down, Greg. That's how we make money on this trade. So we wanted to hit at least our break even. So we just subtract what we paid for the trade to start with. So 225 minus the 375, that gives us our break even price, which is at 221.25. So Boeing needs to break to that level at least before we start going into a profit zone. And then, Greg, I think you can explain at this point what happens here. So we wanted to get to 205, but we don't want it to go beyond that. That's when the trade starts becoming a little bit too toxic for us until hits 185, where we pretty much a scratch at that point there is what we're looking at there. The loss is going to be anytime you do a long option trade where you're spending money, it is going to be what you put into it. In this case, it's going to be the $3.75 or $375 that we'd be standing to lose. Keep in mind, whenever we're short, we do have assignment risk that could also play out here where we could be put the stock, where we may have to buy it. So that is something to also think about when you're putting on these trades. But we're doing the longs to protect ourselves in case we do have that play out there with the assignment.
All right, two interesting ideas there for our viewers to dig into. That is the show for this week. We return on Tuesday, though. The bear bull debate's going to be on BlackRock. Have you and Jay met on the field of honor yet to decide who the bull is and who the bear is?
We have, Greg, and we certainly have. So we'll leave it up as a teaser to decide what's going to come out on Tuesday. But I'm not. I'll just keep it this way. I'm not one to bet against a behemoth. The largest asset manager in the world, I think they still hold the mantle for. So I'll be squarely in their camp. I guess I gave it away.
That sounds a little bullish with a dig into Jay, too, in terms of the work he has ahead of him. I'm sure he's going to do his research as well. As always at home, investors should do their own due diligence and research before engaging in trading. We will be back on Tuesday with the debate on BlackRock. Thanks for watching today, and we'll see you then.